Very few businesses have the luxury of just setting a price based on a plan and then just going to the market and have the market agree to pay that price. Instead, businesses have to determine what the market price for their products will be and then set their costing to meet the market price and earn a desired rate of return. So in the last part of this demonstration problem, our salesman goes out and he does a little market research and he determines that the market price is significantly lower than what his plan was. Customers will likely only pay up to $310 per set. So the selling price will now be reduced from 350 to 310 in order to continue to earn his desired profit. We have to try to control our costs. So in the problem, our salesman goes back to his supplier and negotiates a reduction in the per unit set using probably his market research, and they agreed to reduce their sales price to him from 210 to 190. So here we're going to have a new selling price, a new variable cost per unit, however, our volume is still going to be based on our budget that we calculated in our targeted profit analysis. We will also need to adjust our fixed cost, and our desired profit of 4,900 will remain the same. So in this part of the problem, we're going to be reducing our purchase price to 310. Our volume will remain what we determined it was in our targeted profit analysis of 75 units. Our variable cost will drop from 210 to 190. We're going to be solving for our fixed costs, and we're going to continue to want to earn a profit of 4,900. Earlier, we determined the break-even point using an equation. That equation said that the break-even point occurs when the total sales equals total cost. Well, we're not looking to break even here. Instead, we're looking to earn a profit of 4,900. So we're going to take our equation that we use for break even and we're going to slightly alter it. This is our equation from the break even analysis, but here we're going to add our desired profit, and we're going to designate that to be DP. So now it says our total sales equals our variable cost plus our fixed cost plus our desired profit. So we're going to set the sales to give us a return of 4,900. We will be able to determine our sales because we know the budgeted sales and our sales price per unit. We know our variable cost because we know our volume and we know our variable cost and we know our desired profit. What we're looking here is what level of fixed cost do we need to achieve our goals. So our sales will be equal to our selling price of $310 times the number of units that we plan to sell, or 23,250. That's our budgeted sales. That is going to be equal to our variable cost, which will be now $190 times 75 units plus our unknown fixed costs plus 4,900. So now we're going to solve for our unknown, the fixed cost. So we're going to bring this side of the equation, the whole numbers, over to from the right side to the left side. First, we need to determine what the variable costs were. 190 times 75 equals 14,250. Our fixed costs are unknown, and our desired profit is 49. So now we know that our sales of 23,250 has to equal 14,250 plus the unknown fixed cost plus our desired profit. So when we bring over the variable costs and the desired profit, they will become negative amounts. So that gives us 23,250 minus the 14,250 minus the 4,900. That tells us 4,100 equals our fixed cost. So we have to set our fixed cost at $4,100 in order to be able to earn a profit of $4,900 based on our budgeted sales. And we can use the contribution margin income statement to verify this. We know our sales are going to be our selling price times the volume, or 23,250, and that is going to be less our variable costs of $190 per unit times 75 units. That will give us a contribution margin of 9,000. We'll now subtract out our new fixed cost of 4,100, and 9,000 minus 4,100 gives us our desired profit of 4,900.